back, Investomaniacs. My name is Kitty, and I'm here to read the news so you don't have to. So today we're going to be talking about Apple and their fancy new credit card. I mean, what isn't Apple getting into? If you ask me, this is just one more step towards world domination. Kidding. Kinda. So this fancy new credit card, which by the way is made of titanium, will reward fans with 3% cash back on Apple products, 2% cash back on purchases made with the Apple Wallet, and 1% back on purchases made with the physical card itself. In addition to this, the company will also offer money and debt management tools, which will be located in the Wallet app. So the card was just released on the 6th of August. It's about 6 months after its announcement in March. And this initial launch is reserved for a select group of people who opted into the Notify Me list earlier this year. So the full release is slated for sometime at the end of this month. It's August, by the way. So one of the great things about this card is that any cash back is received same day versus the end of your billing cycle. So this cash can be transferred to your virtual Apple Card where you can use it for just about anything, even sending money to friends and family. However, along with this, Apple has eliminated peer-to-peer payments via credit cards. Another benefit to this card is that there will be no fees. This means no annual fees, no late fees, no foreign transaction fees, no penalty APR. And yeah, that's really good. The regular APR will also range from 13.24% to 24.24%. And as a commitment to their privacy, or to people's privacy, Apple said it will not be able to see your transaction history, and Goldman Sachs won't share or sell your info. The new card will also not affect the existing Barclaycard, Visa, and Apple rewards. I hope I said that correctly. Barclaycard. So what are analysts saying about the card? Well, quite frankly, they are pretty underwhelmed. According to this guy, industry analyst for creditcards.com, Ted Rossman, this card will get a lot of headlines, but its bark is greater than its bite. People will sign up for it, but that will be mostly because they love Apple, not because this card is better than anything that already exists. Apple could have made a similar push for a broader customer base, but it did not. He also mentioned one of the downsides being that as a cardholder, you need to be an iPhone user to maximize your benefits. He also noted how there are several cards which offer better benefits than Apple's, such as the Citi Double Cash card and the US Bank Altitude Reserve Visa Infinite card, which is actually more useful in maximizing your Apple Pay. So I have to agree with him, but on the other hand, brand loyalty is one of the main driving forces behind a lot of large businesses. Like take a look at Starbucks, for instance. One could argue that Dutch Brothers not only has superior coffee, but also has better pricing. And you can also take Lululemon, who I spoke about yesterday, I believe. They have a huge loyal brand base, but you could argue that you can get just as good as gear from Forever 21 or even Gymshark, whose pants are significantly cheaper and, in my opinion, more well-known. So it'll be interesting to see how popular the Apple Card becomes in the future when it becomes a little more widespread. So next we're going to be moving on to Kraft Heinz, this train wreck of a situation since like 2015. So their shares fell almost 15% in Thursday trading. And this is after they released their preliminary first half results showing an exorbitant earnings decline and more than $1.2 billion in impairment charges. So in addition to this, they also announced they would be unable to meet the deadline for filing their 10Q with the Securities and Exchange Commission. So according to Heinz, their net income was cut more than in half to $854 million, which equates to 70 cents per share. In the 6 months period from $1.76 billion or $1.43 a share in the same period last year. Adjusted EPS was $1.44 compared with the $1.89 last year. Sales of $12.37 billion were down 4.8% from $12.99 billion in 2018. For the second quarter, the Heinz had an EPS of 37 cents, which is down from 62 cents a year ago. So the adjusted EPS came out to 78 cents, ahead of the current FactSet consensus of 75 cents. Sales fell to $6.406 billion from $6.690 billion, which is below the $6.564 billion FactSet consensus. So Kraft Heinz Chief Executive Miguel Patricio, I believe that's how you pronounce it. My apologies if not. The level of decline we experienced in the first half of this year is nothing we should find acceptable moving forward. So he became the CEO on July 1st, succeeding Bernardo Hess. So if you remember, in February, Heinz shares tanked to a record low after the company slashed their dividend, reported devastating fourth quarter earnings, announced how they received a subpoena from the SEC about their accounting policies, which resulted in $25 million of inventory accounting corrections, and took $15.4 billion impairment charge related to the valuation of a number of businesses, including the Kraft and Oscar Mayer brands. So the impairment charge was one of the largest in history. And not only this, it was also unusual how the write-down of its Kraft natural cheese business, the Oscar Mayer cold cuts business, and the Canadian retail business was actually carried out. So Heinz does its annual impairment testing in the second quarter of the year and had already taken some charges in the third quarter as a result. At that time, the company reported that 5 out of their 20 reporting units each had excess fair value over its carrying value of less than 10%. So some analytics wrote, quite unusually, the impairment was triggered by short-term developments in the second part of 2018, as opposed to a routine impairment evaluation. When the fair value of several businesses was written down in the third quarter after the annual assessment, it was a warning, since any softness in the underlying business could and did force the company to now take an even larger hit. So in May, Alex Bering, the company's board chairman, said that the company was returning to a path of normalization, but that preliminary first quarter financial statement didn't really represent that and included an estimated $620 million non-cash impairment loss in sales and general administrative expenses related to the EMEA East, Brazil, and Latin American exports reporting units. Changes made in management structure and revised expectations for the coming year were among these factors leading to the triggered event. The second quarter included non-cash impairment losses of $124 million for the sales, general, and administrative expenses related to goodwill, and non-cash impairment losses of about $474 million, which were related to indefinite-lived intangible assets of 6 brands, including Velveeta, Lunchables, and Miracle Whip. The filing put forth by Heinz said these amounts reflect our best estimate of losses at this time. However, we continue to evaluate the amount of impairments and execute and test certain internal controls associated with the assessment. The Heinz stock, which was down nearly 11% on Thursday afternoon trading, is down more than 54.4% for the last year. So I bet Warren Buffett is not happy. Look at that face. Well, this about wraps up what I have for you today. Please like this video, comment below, share if you would, and if you haven't already, hit that subscribe button down below. Check back often where I read the news so you don't have to. Have a good day.